I'm Mira.
Imagine looking at your phone and seeing commercial cargo ships, just being blown up by drones.
Right.
You see Iranian radar sites taking direct missile fire, and factory input costs skyrocketing to levels we honestly haven't seen in years.
It sounds like a total disaster.
Yeah, exactly. You would think the stock market was in an absolute free fall, right? Like you'd assume everyone was rushing to cash.
Oh, absolutely.
But if you check the tape, on Monday, June 1st, 2026, the S&P 500 just casually brushed it all off. It closed incredibly resiliently at 7,599.96.
And the Nasdaq futures didn't flinch either.
Right. They finished up at 30,525.25. It is just a dizzying, completely counterintuitive whiplash.
It really is. And today, we are going to tear into that massive disconnect.
Because there's a lot to unpack.
Definitely. We have this fascinating tug of war happening where skyrocketing oil prices and, frankly, terrifying stagflationary data are slamming into an AI infrastructure boom.
And that boom is basically acting like an impenetrable shield for equities right now.
Exactly. So we are going to map out exactly how a collapsing peace deal in the Middle East and these staggering corporate capital raises in Silicon Valley collided in real time.
And we'll look at why the market ultimately chose to side with the robots over the reality of the physical supply chain.
It's going to be an interesting one.
Yeah. But before we get into the mechanics of that collision, just a quick reminder for you listening. This deep dive is strictly for market context and discussion.
Right. We are here to help you understand the baseline you are operating against.
Exactly. This is not personal investment advice or an investment recommendation. Keep that in mind.
Always.
So let's officially open session 1. What set the stage before the U.S. session?
Well, to figure out why the market completely ignored Monday's chaos, we actually have to rewind the clock a bit to the previous Friday.
Going into the weekend of May 31st, right?
Yeah, exactly. If you were trading heading into that weekend, the backdrop was, honestly, almost unnervingly calm.
I remember that. Volatility was just dead.
Totally crushed. The VIX Wall Street's fear gauge had dropped all the way down to 15.32. People were heading home for the weekend thinking the geopolitical temperature was finally dropping.
But that calm was entirely predicated on diplomatic whispers, wasn't it?
Yes, exactly. The market was aggressively pricing in a tentative U.S. and Iran memorandum of understanding.
Right.
The assumption was that this back-channel deal would officially reopen the Strait of Hormuz.
Which is huge, because that strait handles, about a fifth of the world's daily oil consumption?
Yep, about 20%. So the logic was, if Hormuz opens, the oil supply shock fades, the inflation narrative cools down, and suddenly the Federal Reserve has the breathing room to consider rate cuts.
It was a perfectly packaged, bullish narrative.
It really was.
But then, Sunday night happened.
Yeah, Sunday night changed everything.
At 3:19 a.m. Eastern Time, so that's 7:19 a.m. UTC on Monday morning, Iran officially halted those indirect talks.
And they didn't just walk away quietly either.
No, not at all. They explicitly protested ongoing actions in Lebanon, and their military commanders went on the offensive, threatening a total non-negotiable blockade of the Strait of Hormuz.
Which completely shatters that bullish narrative from Friday. But we also have to place that collapse in the context of what happened physically over the weekend.
Right. The military action.
Yeah. U.S. Central Command, or CENTCOM, conducted targeted defensive strikes against Iranian radar and drone command sites.
This was in Garuk and on Koshim Island, correct?
That's right. And when you have kinetic military action hitting strategic command nodes, diplomatic talks don't just pause, they shatter.
They really do. And, when these Middle East flare-ups hit the news wires, the immediate reflex for a lot of traders is to treat them like an unpredictable natural disaster.
Like a hurricane suddenly hitting a major shipping lane.
Exactly. But I think viewing it that way is a mistake. Iran halting talks immediately after CENTCOM strikes isn't a random weather event.
No, not at all.
We need to look at this through the lens of geopolitical brinkmanship as game theory leverage. They are using the threat of a Hormuz blockade as a highly calculated immediate lever.
Trying to force a specific outcome.
Right. Namely, forcing the U.S. and Israel to halt operations in Lebanon.
And that framing completely changes how you model the risk. Because they aren't trying to destroy the global economy. They're trying to exert the precise amount of economic pain required to achieve a localized geopolitical outcome. It's a deliberate, high-stakes negotiation tactic utilizing energy markets as the hostage.
It is. But here's the wild part. While the Middle East was escalating and threatening to choke off the global energy supply, Sunday evening brought this massive, completely opposing data drop from Asia.
Oh, the South Korean data.
Yeah. At 8 p.m. Eastern Time, South Korea released its May export numbers.
And those numbers were simply historic. I mean, exports surged by 53.2% year over year.
Wow.
To put that in perspective, that is the largest single increase South Korea has recorded since January 1984.
Let's stop and think about 1984 for a second. That was the dawn of the personal computing boom.
Exactly.
And South Korea is effectively the canary in the coal mine for global tech hardware, right?
Mm-hmm.
Because they manufacture the advanced memory chips and silicon components that go into literally everything.
Yep. So when their exports jump 53%, it means the physical supply chain for AI data centers is moving at breakneck speed.
Which totally validates the entire concept of AI capex as a cycle-agnostic arms race.
Absolutely. Technology giants are buying hardware regardless of interest rates, regardless of oil prices, and regardless of what the broader economy is doing.
They just do not care.
They don't. And that sheer volume of hardware demand was so intense that it acted as a perfect counterweight to the geopolitical dread. Before the U.S. market even opened on Monday, Asian indices were soaring on this export data. The KOSPI in South Korea actually closed up over 3.5%.
That is massive.
It is. It set up this incredible dynamic for the U.S. Open. You had a collapsing Hormuz peace deal threatening the physical economy, directly offset by a booming Asian tech cycle validating the digital economy.
What a setup.
Yeah.
So let's briefly wrap that up. Going into Monday, we were caught in a massive tug-of-war. The Hormuz talks collapsed, threatening oil, but Asian tech exports exploded, showing AI hardware is on fire.
A literal collision of two different worlds.
Exactly. We'll take a short break, and when we come back, we'll dive into how the U.S. market actually handled that collision.
Sounds good.
Right, we are back. Which brings us to session 2. What moved markets during U.S. trading hours?
Well, when the U.S. trading day finally kicked off, that collision we just talked about got even more intense, and it started with a massive stagflationary data shock.
Oh, right, the ISM data.
Yeah. At 9:45 a.m. Eastern Time, the U.S. ISM manufacturing PMI for May was released. And, if you just looked at the headline number of 54.0, you might think things were expanding nicely.
Sure, 54 looks fine on paper.
But when you dig into the internals, they painted a genuinely terrifying picture. They completely contradict the headline optimism.
Walk me through that.
Well, the employment index actually fell into contraction territory. It was sitting at 48.6.
Wow, okay.
So that means factory managers are actively shedding jobs, pausing hiring, or cutting shifts. But simultaneously, the prices paid index, which measures the raw materials those factories have to buy, skyrocketed to a massive 82.1.
82.1. That is absurd. Stagflation for the Federal Reserve is like trying to put out a kitchen fire while the basement is flooding.
That's a great way to put it.
Right. If they cut interest rates to save the factory jobs, the flood, they pour gasoline on the exploding input costs, the fire. You have exploding costs colliding with softening labor demand. We talk a lot about central bank credibility as an inflation anchor. And a prices paid print of 82.1 severely limits the Fed's room to maneuver. They cannot step in and save the market if equities falter, because cutting rates would legitimize that inflation metric.
And to make matters worse, as the market was digesting that trap for the Fed, the geopolitical risk premium materialized in real physical terms.
Right, it wasn't just talk anymore.
No. Monday morning brought confirmed reports of multiple drone strikes on commercial cargo vessels in the Gulf. Including
a direct attack on a U.S.-owned ship, right?
Yes, the container ship MSC Sariska. And the energy markets reacted violently to physical steel getting hit.
I saw that. WTI crude oil spiked intraday. It went from a low of $88.45 all the way up to a peak of $94.78.
Just a massive move.
Yeah, it eventually settled slightly lower at $92.45, but that is a huge intraday swing for global crude.
Which brings us to the core mystery of the day. You have oil surging on physical drone strikes. You have stagflationary data threatening to make discount rates act as financial gravity, pulling equity valuations down. Historically, that combination is toxic.
Absolutely toxic.
So why didn't the S&P 500 collapse? The 10-year Treasury yield actually eased slightly to close at 4.475%. And high-yield corporate credit, like if you look at the HYG ETF, it barely flinched.
It is the ultimate disconnect.
Yeah.
I mean, if you're holding a standard 60-40 portfolio right now, you are caught right in the middle of this. On one hand, it feels like the market simply isn't paying attention.
Right.
But if we look closer, there are two distinct forces keeping equities afloat. The first is tech, mega capex masking broader fragility.
Yeah, the big guys.
Right, the companies driving the S&P 500.
Yeah.
Your Apples, Microsofts, Alphabets. They generate such massive free cash flow that they're effectively immune to a manufacturing slowdown.
They really are. They don't care if factory employment is at 48.6 because their margins aren't tied to physical assembly lines in the Midwest.
Exactly. They are essentially isolating the major indices from the industrial slowdown.
And the second force keeping the market afloat is the speed of algorithmic trading versus the speed of physical shipping.
What do you mean by that?
We're seeing markets pricing ahead of physical reality. While those drones were striking ships in the Gulf, there was a frantic U.S. brokered diplomatic effort happening behind the scenes during U.S. trading hours.
Oh, I saw that across the tape. It led to Hezbollah allegedly communicating consent for an unconditional ceasefire in Lebanon.
Yes.
And just to clarify, as we report this, we're not taking sides on any of the political figures involved. We're just conveying the information from the sources. But apparently this was confirmed via calls between Benjamin Netanyahu and Donald Trump.
Exactly. And that diplomatic rumor mill moves faster than an oil tanker. Traders looked past the immediate kinetic strikes in the Gulf, and they aggressively priced in this Lebanon de-escalation.
They're assuming a domino effect.
Right. The underlying assumption is that if the conflict in Lebanon cools down, the domino effect will eventually force Iran to back off its Hormuz blockade threats, causing the oil shock to fade. The market is betting heavily on a diplomatic future rather than the kinetic present.
That is a staggering amount of faith in back-channel phone calls over, literal burning cargo ships.
It really is.
So to quickly summarize U.S. trading hours, equities essentially ignored terrible stagflation data and physical drone strikes. They stayed afloat because tech megacaps are immune to factory slumps, and traders priced in rumors of a Lebanon ceasefire.
A very strange day.
Indeed. Let's take another quick break. When we return, we will get into the corporate events and what to watch next.
Welcome back. Let's open up session 3, corporate events recap and what to watch next.
Well, while the physical economy was showing cracks and relying on diplomatic rumors, the digital economy was busy building its own sovereign reality.
Yeah.
The corporate news flow on Monday was nothing short of a hardware tsunami.
Oh, completely dominated by Nvidia.
Yeah. Nvidia's presentation at the Computex conference in Taiwan, which happens late Sunday night into early Monday morning, was just a flex of absolute dominance.
They didn't just announce a minor chip upgrade, did they?
Not at all. They launched the Vera Rubin autonomous AI processor. They introduced the Alpamayo 2 model, which is specifically designed for the compute-heavy demands of robotaxis. And critically for the enterprise space, they detailed deepening PC software partnerships with Microsoft to embed AI agents directly into the Windows operating system.
See, what stands out to me isn't just the speed of innovation, it's the physical manifestation of it.
Right.
This proves the physical infrastructure rollout of AI is accelerating flawlessly. We are moving past the phase of theoretical cloud-based software demos. This is hard, silicon-hitting data centers and enterprise desks.
Yeah, it's real now. But Nvidia wasn't the only major AI player making moves. Right in the middle of the trading day at 12 p.m. Eastern Time, Anthropic confidentially filed for a U.S. IPO.
Oh, an Anthropic IPO is going to be a fascinating stress test for the market.
How so?
It represents a massive upcoming liquidity event. I mean, it is one thing for investors to assign a multi-trillion-dollar valuation to Nvidia because Nvidia is selling the picks and shovels.
Right, they make the hardware everyone physically needs.
Exactly. It is an entirely different proposition to see how Wall Street values the underlying AI software models themselves, which are incredibly capital-intensive to train and run.
And speaking of that capital intensity, Alphabet decided they weren't going to wait around to see how the public markets value AI software.
No, they did not.
After the U.S. closed on Monday at 4:40 p.m. ET, Alphabet dropped an absolute bombshell. They announced a proposed $80 billion equity capital raise.
80 billion.
Yeah, and the stated purpose is specifically to fund their AI infrastructure build-out.
To put $80 billion into context, that is larger than the market capitalization of most companies in the S&P 500.
It's massive.
But the most crucial detail of that capital raise isn't the total number. It's that it includes a $10 billion private placement from Warren Buffett's Berkshire Hathaway.
I honestly had to read that headline 3 times. Warren Buffett, the ultimate traditional value investor, the man who famously avoided technology stocks for decades because he couldn't predict their long-term competitive moats, is writing a $10 billion check for AI servers.
It is a generational paradigm shift. Value investing is formally endorsing the massive, capital-intensive AI infrastructure spend.
Which is huge.
It is, because historically, value investors despise massive capital expenditures because it eats into free cash flow. But when Berkshire Hathaway signs off on this, it validates the entire CapEx cycle thesis.
It signals that the smartest money in the room believes the return on investment for these AI models will ultimately justify the staggering upfront costs.
Exactly.
Honestly, looking at the board today, the juxtaposition of all these events is almost comical. We have oil prices jumping so high from literal drone strikes and blocked straits
That you might need to grab a piece of Alphabet's $80 billion equity raise just to afford to fill up your gas tank on the way home.
Exactly. And yet, Warren Buffett just threw $10 billion at Google's AI infrastructure.
Which tells me even the Oracle of Omaha is hoping a robot can eventually figure out how to tame this manufacturing inflation, because the Fed certainly can't right now.
Yeah, if we can get a surprise ceasefire rumor in Lebanon to stabilize the S&P 500 on a Monday, maybe there's hope the Fed will surprise us with a rate cut too. Until then, you might as well just have Nvidia's new AI drive your robotaxi far away from the gas pumps.
Fair point.
Before we move on to our trading segment, let's quickly outline what to watch for tomorrow, Tuesday, June 2nd. The Federal Reserve is going to be front and center.
Yep.
At 1:50 a.m. Eastern Time, Fed Kashkari speaks, followed by Fed Hammock at 8:30 a.m. ET. At 10 a.m. ET, we get the crucial jolt test report for April job openings and quits, which will be vital given today's weak manufacturing employment data.
Definitely.
10 minutes later, at 10 a.m. ET, the IBD and TIPP Economic Optimism Index drops. And finally, at 11:30 a.m. ET, the Treasury is hosting a 6-week U.S. bill auction.
That JOLTS report is going to be the most critical data point of the morning. If job openings fall significantly, it might give the market more confidence that wage inflation is cooling, even if factory input costs are rising.
All right, let's move into our bonus session, paper trading. We run this public paper trading experiment to test if our macro analysis actually translates into alpha or if we're just, making noise.
Right.
We started this hypothetical portfolio with $10,000. As of today's close, June 1st, 2026, the portfolio value sits at $11,270.51.
Not bad at all.
Yeah, that is a 12.71% return, which is nicely outperforming the S&P 500's 6.65% return over the same period.
So what's your trade?
I start with my trade for tomorrow's close. I am deciding to sell 10% of the portfolio's allocation in the energy sector ETF, which is ticker XLE, and I want to buy 10% in the communication services ETF, ticker XLSE, which heavily weights companies like Alphabet and Meta.
Okay, what's the justification there?
It's based on the diplomatic news. We are seeing geopolitical brinkmanship pushing the oil risk premium to an absolute peak right now. But as we discussed, the Lebanon ceasefire news shows markets are willing to price ahead of physical reality.
Right.
If that ceasefire holds, the fear premium in oil is going to deflate incredibly fast. Meanwhile, the AI CapEx cycle is an undeniable cycle-agnostic arms race. With Alphabet proving they can raise $80 billion and secure Berkshire Hathaway's backing, I want to sell the panic-driven energy spike and buy the structural, unstoppable tech CapEx trend.
Well, I see the logic, but I am going to have to push back heavily on that positioning.
Oh, really?
Yeah, my trade is the exact inverse. I want to sell 9.8% of XLC and buy 9.8% of XLE.
I love it when we end up completely on opposite sides of the book. What is your rationale for selling communication services by energy today?
It comes down to market mechanics and the reality of physical inflation. Alphabet's $80 billion equity raise is historically bullish for their long-term growth, yes. But in the immediate mechanical short term, An equity raise of that size introduces massive dilution.
I see what you mean.
The market suddenly has to absorb $80 billion in new equity supply, which creates a huge overhang for XLC. Simultaneously, I think the market is dangerously complacent about inflation.
Because of the stagflationary ISM data.
Exactly. That data and the actual physical drone strikes in the Gulf prove that energy shocks as a delayed consumer tax are an imminent threat, not just a game theory abstract.
So you think traders are staring at the screens, blinded by the tech announcements, and completely ignoring the reality of the supply chain on the ground?
Absolutely. I believe we are seeing a dynamic of stale macro data versus real-time pricing. The market is pricing in a rosy diplomatic future, meaning the physical oil supply risks are actually being severely underpriced right now.
That's a really interesting point.
Yeah, and that makes energy the absolute best hedge against both inflation and geopolitical escalation.
Well, this is why we aggregate our trades. Because our views were almost perfectly inverted today, the math on the final aggregated decisions for the June 2nd close is essentially a wash.
Pretty much.
The net result for the portfolio is to buy $13.52, which is just 0.1% of the total portfolio of XLC, and sell $13.52 of XLE. Our opposing views essentially canceled each other out.
Which is a perfect microscopic reflection of the exact tug-of-war happening in the broader market today.
Very true.
And as always, a necessary disclaimer, this is an educational experiment. This is not financial advice. Past performance does not guarantee future returns. Do not copy these trades. This live experiment may fail at any time.
To wrap up today's deep dive, I want to leave you with a final thought to mull over. As you watch Nvidia hardware announcements and Alphabet Capital raises completely overpower the reality of drone strikes and stagflationary manufacturing data, you really have to wonder, are we reaching a point where the technology sector operates as its own sovereign economy, completely decoupled from the physical constraints of oil, shipping lanes, and traditional manufacturing?
Share your thoughts on whether tech can keep defying financial gravity in the comments below.